Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Maddie Radner, Director on the Nasdaq Market Intelligence Desk, Talley Leger, Chief Market Strategist at the Wealth Consulting Group, and Kevin Mahn, President and CIO of Hennion Walsh. We're here to discuss why volatility and uncertainty generally lead to some attractive investment opportunities. It is great to have all of you with us. Welcome back to Trade Talks. Kevin, you tend to have themes around your writing, and March Madness could not align better than the March that we just had.
Yeah, I think it's fair to say that March Madness this year started in the stock market, not necessarily on the basketball court, and many investors are happy to see March now behind us, as March actually was one of the worst performing Marches since 2022, and the first quarter of 2025 was its worst first quarter since 2022. But that all leads to opportunities ahead, in my view. And I see a final four factors, Jill, that's going to allow us to actually grow in the second half of the year. And all four of those factors could take place in the second quarter. One, we're going to get some more certainty around tariffs tomorrow, whether or not they're as reciprocal as we originally thought, or perhaps are more reciprocal than we thought, but at least we'll know and we'll have certainty and we can plan around that. Two, the Federal Reserve indicated just last week that they stand at the ready to step in and become accommodative if, in fact, the economy deteriorates further or if the job market worsens. I still believe that there's a 25 basis point cut on the table for the end of the second quarter of this year. That would be a tailwind if that happened. Third, the extension of the tax cuts. If that doesn't happen, that's a deal breaker. That's a game changer, because that would amount to one of the single largest tax increases in our country's history. Then the final four factor, I would have to put continued spending as it relates to defense, as we were speaking about earlier, and as it relates to AI infrastructure. Those four themes, I think, are going to position us for a strong second half of 2025.
Yeah, and Talley, what you might call a crisis of confidence and volatility perhaps took investors by surprise. At the end of the day, and this isn't your first rodeo with a volatile environment, cooler heads do prevail when you kind of take a step back and think about the fundamentals.
Absolutely. So look, when we look at weekly economic activity and the earnings outlook for this year heading into next, the fundamentals are looking pretty stable here. So when we get these bouts of volatility and elevated uncertainty, we get excited at the Wealth Consulting Group, and we're shopping the sales here as we speak.
Yeah, I mean, if you were concerned about valuations where they were at the peak in February, it's more attractive now than it was before, that's for sure.
Well, everyone likes to say that stocks hate uncertainty. You actually just mentioned that, Kevin, but we love it, because if you look historically, high uncertainty actually lines up with tradable lows in stocks, and this time is no exception.
Yeah, and Maddie, do you think we're at somewhat of an inflection point when it comes to the asset class as it relates to small caps?
Yeah, I think there's definitely two sides to the small cap trade right now. One is still a little bit more cautious, especially because historically, more volatile and sensitive more volatility is definitely kind of negative for the small cap space. These small cap companies do rely on debt, and they're really dependent on easy financing. So as we've seen a little bit higher of inflation, a little bit lower of consumer sentiment and volatility around tariff headlines, it could threaten kind of the easier interest rate environment that these smaller cap companies are looking for. That said, the other kind of more positive outlook on small caps is that we could see small caps benefit from tariffs, specifically companies with strong business models, pricing power, and sturdier paths to profitability, especially as U.S. firms might have to kind of change and adapt to supply chain strategies and maybe take a look at small cap companies.
Well, if you get the 25 basis point cut, as Kevin thinks we will, that's going to be, a tailwind, or a start at least, for the financing, as you had mentioned. Kevin, does the tech trade go away, or investors more discerning in terms of where they're looking for opportunity?
The AI revolution is alive and well. And for those that believe that the Mag 7 trade is dead, I would suggest that you revisit the Mag 7 trade, maybe back out Tesla at this point in time, as there's some interesting dynamics around Tesla right now that don't kind of qualify in that Mag 7 technology related boom. But we were talking about valuations earlier. The Mag 7 right now is currently trading at a PE ratio of around 25. That's the lowest it's been since the end of 2022, prior to the beginning of its meteoric run. Remember that the Mag 7 accounted for 62% of the total return of the stock market in 2023, 54% in 2024. Thus far this year, down 15%, while the non-magnificent 493 are relatively flat. So that just reminds me that as much as I think they're trading at attractive entry points right now, and the technology trade and the AI revolution is still alive and well, consider diversifying into some of those non-magnificent areas like utilities, like value, like international. We're seeing changes in market leadership, and I believe that's healthy for the sustainability of this bull market rally.
Yeah, and that's a good point, because Talley, at the beginning of the year, prior to the volatility that peaked in the U.S. markets, coming out later in February, the international equity trade was on because investors were looking for more attractive valuations.
Absolutely, and we have been there, and in fact, compared to some of our peers in the RIA space, we actually have a relatively healthy overweight to the international segment. And I think the biggest catalyst right there, which had been a barrier for the past 14 years, was the strength of the US dollar. That's the opposite now this year, and I think it's really helping give a tailwind to some of those names.
Do you think investors need to recalibrate their expectations as well? I mean, the returns that we saw over the past couple of years, I would say that is an anomaly and not necessarily, reflective of what the average is when you think about 7-8% return.
Yeah, and I would say that some of the analysts' expectations, especially for the European earnings, have been ratcheting higher, and that's another positive that you could add to the international thesis.
Is there one region or regions that you are more bullish about than others, perhaps?
Well, I think generally international makes a lot of sense, so we're happy to see that area of the global market starting to do well finally after so long. But as I say, I think things are starting to align nicely for Europe. Also fundamentally, we talked about this earlier, we're seeing a dramatic fiscal policy regime shift, the likes of which we haven't seen since World War II.
Yeah, it really is interesting, Maddie, because when you think about, another tailwind for the small caps is people are looking for different ways to diversify their portfolios. There are some really good, and we've spoken about this before, there are some small and mid cap treasures that just haven't had the exposure.
Yeah, right now a space that a lot of people are speaking about is the healthcare space. About 97% of Nasdaq's listings are in the healthcare space. And most small cap companies see products manufactured and sourced in the US, especially some of our smaller cap healthcare companies. RBC actually noted this morning the impact on US biotechs of pharma tariffs could be limited just because they would benefit from their US counterparts as opposed to some of their foreign competitors.
It sounds as if, Kevin, that the tariffs are more regionally focused and sector focused. Am I thinking about it the right way?
I think you are, but of course that could change in the next 5 minutes or with the next tweet that's out there. But from my standpoint, tariffs present more of a growth scare than they do an inflation scare, right? Because generally what causes inflation is excess money chasing too few goods. In this scenario, I always think of the example that a consumer has $100 to spend. There's two products that they're looking to buy worth $50 each. Let's say they put a 20% tariff on both of those goods. So they become $60 each. Now the consumer can only afford one of those products and perhaps look for an alternative product that's lower cost or keep that $40 in his or her pocket. That creates the growth scare because 70% of our economic growth comes from consumer spending.
Yeah.
So I think that's what Chair Powell was trying to touch upon when he said that the tariffs would be transitory in terms of their inflationary impact, and that's why they believe inflation might spike this year, but then come closer to their 2% target by the end of next year.
Yeah, which is interesting because you can see the dichotomy too with how the
I
US...
hate using transitory again, but he said
I know.
it.
Well,
he said it, not me.
Keyword.
When it first became part of the vernacular again, that was my first reaction as well. But you could see the difference in terms of how the EU and US are approaching monetary policy because our economy was so strong.
That's right.
Going into this, you have to question yourself: if you get interest rate cuts, is that at the behest of your economy doing well? It's a balancing act.
Well, when trying to think around some of the winners and losers in this environment, especially the threat of potential tariffs, it seems to me that that is largely a goods-related concept. Remember, and this does a couple things for us in the conversation, this is largely a service-based economy. So it allows us to push back against some of the recession concerns that are kind of bubbling up here in the narratives. But it also kind of squares firmly on the financial sector. And this gets back to what we were saying earlier around Fed rate cuts. I think that's great for the banks, especially as it steepens the curve here. So I still think that our financial positions are going to do well in this
I mean, even if you look at international banks, European banks is the best performing
100%.
sector.
Yeah.
I'm not sure how consumers, how they will feel about absorbing more, costs that are rising. Even, for the past 5 years, it's almost as if companies had, an excuse to pass inflation costs down. I just don't think the consumer's going to absorb that.
Well, and we've seen it, to your point, and thanks for kind of showcasing my piece, Crisis of Confidence. So sentiment has kind of taken a hit here, absolutely. But I like to lean into these opportunities here, Crisis of Confidence, and while the staples positions have done well in this kind of tactical risk-off environment, I think a kind of sell the rumor, buy the news strategy might start to make sense in the cyclical consumer areas.
Yeah, and Kevin, I think it's important to point out yet again that the economy and the market are two very different animals.
Very different things.
And you have to be aware of that as an investor and getting through the noise with some of the headlines.
Yeah, and I think going back to level setting expectations for this year, and I'm a quant guy, I love statistics, it helps people understand my viewpoints, right? So going back to 1950, there were 9 times when the stock market rallied by 20% or more in consecutive years. 2024 was the 10th time. Here's the good news. 90% of the time, the stock market was higher the following year. Here's the bad news, only by an average of 3.6%. So we're going to be challenged this year to find attractive pockets of growth opportunities. I think you'll find them in small cap biotech, for example. I think you'll find them in aerospace and defense. I think you'll find them in areas of the AI ecosystem beyond just semiconductor chips, including some of the data center REITs, the cooling solutions, and then the power solutions, which generally come from utility companies. So the opportunities are out there, but we do need to revisit our expectations for what the stock market may have to offer in the 3rd year of this bull market rally.
Right, and once we get to the back half of the year, Maddie, the IPO pipeline is still robust. It's quiet now, right? But there are companies that are looking for.
We are seeing M&A pick up in the mid-cap space, which is definitely kind of provides a nice runway for the IPO market to open. Once we see M&A, then typically we do see kind of the IPO window open up afterwards. Right. So we have strong expectations for the IPO market to open back up in the back half of the year now. First, we thought it was going to be kind of earlier on, but we have seen a lot of companies come to market this year so far, but I think some of the unicorns and some of the larger cap companies will take their time with this one and wait to the second half of the year.
Yeah, which is interesting too, because we're seeing it in the private and VC markets as well. So it's not specific to just how the public markets are perceiving the environment.
Well, I'd like to kind of key off what you're saying about SMID caps, and while it has been fits and starts, we agree we would love to see a broader market. But remember, if we're right about financials and everything we just discussed there, small caps have a pretty large representation in the banks and financials. So if those challenges go away, I think it could help give small caps a lift similarly.
From the perspective of an advisor, are you concerned about this push for alt products and funds in client portfolios?
Well, I see it as an opportunity, and I don't want to let the cat out of the bag, but we've done a good amount of product innovation, and we're actually on the cusp of announcing a new strategy in our suite of solutions at the Wealth Consulting Group.
Oh, so I got crisis and confidence, and I got that as well. Kevin, it's interesting because I know munis are your space.
Yes.
Heard a lot of positive things with strategists on the show and the attractiveness of munis right now.
Yeah, I mean the demand and the allure of tax-free income never goes away, right? I do believe that the tax cuts will be extended, but a lot of the additional tax cut that he's looking to put in place and perhaps be offset with some incoming revenue from the tariffs may not actually come into place. So high net worth individuals are going to continue to look for tax-free income. And right now their tax equivalent yields are very attractive. And then I think about different ways to access municipal bonds. How about closed-end funds? Still trading at very attractive discounts, and they employ leverage, much less like banks, once short-term interest rates come down, that's a cost savings to the fund manager who employs leverage. Who gets the benefit of that? The closed-end fund holder through yield enhancement. So I do see opportunities ahead this year for both municipal bonds directly and municipal bond closed-end funds.
Well, speaking of tariffs, is this something that we're going to go through the entire administration as a tool for leverage?
Boy, do I wish I had an answer for that one. What I will say is that the second quarter is going to be bumpy. Right. And the only thing that's certain right now is there will be more uncertainty over the next 3 months. But I think all of this positions itself for a very strong second half of the year. Once we have more clarity around tariffs and trade, once we actually see that first potential rate cut from the Federal Reserve, once we get the extension of the tax cuts, and then once we see companies continuing to invest in CapEx spend.
Yes.
All of that is very positive, plus earnings growth, which we're forecasting around 7% year-over-year growth for Q1 right now. That would mark the 7th consecutive quarter of year-over-year growth. So underlying all the chaos right now and the March madness, the markets and the economy is relatively strong. But my concern is that economic growth forecasts have come down significantly for Q1. But the Federal Reserve is watching, and they stand ready to jump in if they need to.
Yeah, they certainly do. And Talley, to wrap up here, your outlook as well, a little bit more positive for the second half?
Well, yeah, and I think you've got to take some of these nowcasts with a decent grain of salt. So where the Atlanta nowcast model is a little bit challenged, if you look at the New York version, the sign is completely different. So again, you know, cooler heads will prevail. I'm a fan of that adage. And I think peering through the murkiness, if you look at the weekly activity, we've got a 2% handle on the economy, and I think that's pretty good, and it's a good enough reason to be involved in equities here.
All right, appreciate everyone's insight. Thanks for joining us on
My
Trade
pleasure.
Talks. And thanks for joining me for MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.